Okay, there are more people joining, but I think we may as well just get going. It's now 11 o'clock on Friday. As usual, we've got a bit of news to run through first before we get to our guest. And our guest this week is Henry Butt from AEW UK REIT. Richard will be talking to him. And actually, Richard's going to be doing most of the show today because we look at the news stories. The two of the three are property ones. But I wanted to have a look at Jupiter Green first. Now, you can see the problem there. The distance has got wider and wider. It's not huge, and it doesn't offer a yield anymore. I think actually no, that should be 53 rather than 53. And it just published results this morning, and they're not brilliant either. So it benchmarks itself against the MSCI World Small Cap Index, and you can see it's about 10 percentage points behind that over the year to 31st of March. And the share price return is diabolical. So by the time we get through to the end of March, the discount will hit over 30%, which is ridiculous for an equity fund. That's narrowed into 25.2 now. But it's only got total assets of about 50 million, which is why I knew that market cap was wrong, which is the same size as it was back in 2008. So this is a fund that's really struggled to be relevant. And because it's relatively small, the ongoing charges ratio is relatively high, so over 1.5%. That's obviously a problem. This is from its fact sheet. I've had fiddled this, had some numbers in, but you can see here, relative to the MSCI World Small Cap Index, it's been really pretty awful. So over 10 years, 91.9 against 212.8, and the share price terms only 45.8. And then if you look at discrete periods, this is what I added in here. You can see it's underperformed over the last 12 months. Did okay the year before, underperformed. So it's built up this sort of cumulative underperformance over some time. So it's really not got a great track record. And that's under two different managers, to be fair, and actually two different styles. So in 2021, when Charlie Thomas decided he was going to leave Jupiter, they did think about the whole strategy and what they were going to do with it. So they shifted it towards smaller companies driving environmental solutions, which is more likely to be small cap stocks. And they therefore introduced the new small cap benchmark. They were paying a dividend that was de-emphasized and then scrapped. Instead, the focus, they said, was going to be on generating capital growth. However, the NAV has been flat ever since. And the main problem that we've got here is that it's moved into small cap growth. Growth stocks sold off when rates went up. We know that hit everybody. And small caps have lagged as well. So those two big headwinds have been working against it. And maybe it just changed strategy completely the wrong time, but there we go. The other thing they did, and it's quite obvious from the chart we showed you earlier, is they abandoned the discount control, and it was all sort of done under the radar. So they had a pretty strong commitment to using buybacks and issues of shares to keep the share price quite close to the NAV. And that was just reiterated in report accounts after report accounts. And definitely, it was in the one in 2020. But in 2021, it wasn't really mentioned. I know there'd been some volatility around COVID, and that upset things a bit. But by the time we get to 2022, the discount widened, and then the board didn't really sort of say anything about it. They sort of said, well, we're going to hope for the best when the market sentiment improves and the discount will narrow in again. Well, obviously, that did not happen. So what they've said this morning, and it was kind of buried, but we picked it up and put a news story on it. The board is now thinking about what the future of the fund should be. And it may be that it doesn't continue as it is. So basically, they've kind of pressed the starting gun on some kind of corporate action. Now, my only reservation with this is not that there's not good reasons for doing this, is that this seems to be initiated by this chairman who's been on the board for way too long, and has sort of been running the show. And I just prefer that somebody a bit more independent had made that decision. But there we go. There's not much we can do about that. He's actually said in this report that he's not going to go again this year, and neither is the chair of the audit committee. And the reason cited is saying, well, it might be quite hard to hire somebody just to manage the run off of the company if that's what we decide to do. But obviously, all of this is still up in the air. And there are no shortage of people that are prepared to do their short-term jobs. But there we go. That's not going to happen. Assuming that we'd say, right, this is not going to happen. This is not going to work anymore. We're going to get rid of it. The most obvious thing to do is just to roll it into impacts. And there are lots of good reasons for doing that. So firstly, impacts, although it's on a discount, and we'd rather it wasn't a discount, does trade at a much tighter discount, so about 10%. So you get an immediate share price uplift if they did that. It's got much better long-term returns, although slightly behind very short-term. So, but you can see that over 10 years, it's almost double the return of JGC. Obviously, because it's a much bigger fund, much lower ongoing charges, and it's far more liquid, so it's well over $1 billion market cap, even on the 10% discount, and the fact that it's been to buy back stock. So that just seems to me to be the obvious thing to do if we're going to get rid of JGC. I think it's a shame to see that fund go, but it has struggled for a long time. So that's all I wanted to say. I'm going to hand over to Richard.
Thank you, James. I'm just going to share my screen. Okay, so a couple of stories, big stories here from the real estate sector. Firstly, with Hammerson. So they announced a big sale this week, which I'll get onto, but this is their chart. And I've taken it back for 10 years just to show how big it's been impacted. It focuses on retail, and this pretty much shows the retail sector in the chart, basically. But over the last couple of years, it's sort of steadied, and values look like they are starting to hit the bottom, and a recovery may be in place. So they sold their 40% stake in Value Retail, which is an outlet centre sort of consortium, and they sold it for 1.5 billion, which gained cash proceeds of 600 million for them. So these outlet centres, I think the most prominent one is Vista Village. I think everyone would know what that is, and there's sort of 8 others around the world in sort of big European cities and New York as well. So, but it was at a massive discount to what it was valued on their books at. So it was valued at 2 billion or 1.1 billion in cash. So a sort of $500 million discount they took on that sale. And they said that's justified because, I mean, it was such a complex structure. It's very illiquid, and it was very yield diluted for them as well, sort of 2% yield. So they've taken this decision to sell now, take the cash, and they're going to recycle that cash into higher yielding stuff. So, but first of all, they're going to reduce their debt to bring that down to 23% LTV, which is a good thing. And then reinvest into their core markets, which is shopping centres around sort of the UK, France, and Ireland, at much higher yields. So if you compare that sort of 2-3% yield in the Value Retail compared to what they can get in UK shopping centres, especially within their own portfolio. So a lot of their stuff is they've sold stakes into JV partners. They'll look to sort of buy those back and take 100% control, and they'll look to invest in sort of refurbishing and repurposing their assets that they've got at the moment at a much higher yield. And they're also going to return money back to shareholders via a buyback of about 10% of their market cap, which is quite punchy. So that's all good news. So this is Hammerson Shopping Centre, so worth 2.6 billion. And like I said earlier, there seems to be a signs of a reset in the retail sector after sort of probably about 10 years of decline. So within their own portfolio, values rose for the first time in almost a decade in their UK and France assets. And they're also seeing positive rental reversion. So that means if they were to reset all their rents at today's values, it would be a lot higher than what they've got at the moment. So that's the first time they're seeing that since 2018, which is good news. So that shows as those leases come to an end, they can renegotiate them or bring new people on higher rents. So rental growth looks like it's coming again for the first time in a long time, which is good. And they also talk about the large retailers also having a focus on sort of best in class assets and best locations as well. And that's happening, that's coming through in their portfolio, which also will lead to rental tension and hopefully higher rents. So I think it's a good thing. Obviously, a massive valuation hit, which affected their NAV, which went down massively. But it's a good thing to get this off their books and start redeploying into high yielding stuff and returns going up. The other one I wanted to talk about was Unite Students. This week they raised 450 million in a placing. You see there, a little bit of that was from retail investors as well, which is good. It was done at a 2.6% discount to the closing price and a 7% discount to their NAV. And with these proceeds, it gives them firepower of about 700 million, which they expect to get away pretty quickly in the next 6 months. So they're quite detailed in what they're going to do with the money. So they're going to acquire 7 assets from its open-ended fund, which they have a stake in, and sell a couple of their current assets into that structure as well. So a net investment of 170 million. And they've sort of outlined 45 million of asset management enhancing capex, which will generate a yield of 5.9%. Then 70 million is going to go into fund their Newcastle development at a 7.3% yield, which is good. Another 200 into committed developments in Bristol and Glasgow, and 2 other further developments down the line, which will cost another 380 million. And I think people are excited about this because of the strong dynamics in that sector, really. So, I mean, if you look at sort of the more macro stuff, student numbers, sort of 18-year-olds by 2030 is going to go up by 16%. So that should feed through into more sort of UK applicants to universities. International demand is as well, 3% growth since before the pandemic. And there's a huge supply and demand imbalance too, with purpose-built student accommodation new build supply is down 60% on the pre-pandemic levels, and also the number of houses in multiple occupancy has dropped over the last few years due to changes in that sector. So this should all lead through to rental growth over the short and medium term, which is all a good thing. So I think that is everything I want to talk